On today's episode, we are going to be doing something a little bit different. We're going to actually be jumping into a balance sheet. Instead of spending a ton of time trying to tell you about theory, we're just going to pick some companies. We're going to look at their balance sheet and we're going to give you our take on, hey, what really matters here and how you can do the same for your business. And stay tuned for this week's tax tea because you don't want to miss it. So welcome back Lola. Great to have you back.
I'm happy to be here. Hello to our audience. Another beautiful day in Stuff Your Accountant Isn't Telling You, Business Talk Library World. You're going to ask me a question?
Awesome. How has your week been?
My week has been good, man. It's been a good week, very productive, knocked out a bunch of stuff on the marketing side, have some initiatives we're working on. Working with clients on some things, finished up a client report out for the year that I'd been working on for some time on Monday. So that was a pretty big win for me. So it's been a good week. How about you? How's your week been? We've had some exciting news this week all around. I don't know what we can share, what we can't share, but how you doing? How you feeling?
I'll say, it's been a busy week. We've been getting a lot of stuff done, onboarding some new clients. We had an onboarding call for a new law firm that we're working with out in California. So making progress there, helping some other law firms make more progress and really just solving some client problems.
Yeah.
Kicking up some content stuff that we're doing with the accounting high team. So doing some great stuff there. In talks with working with the Cloud Accounting Podcast, which Cloud Accounting Podcast is the #1 global bookkeeping, tax, and accounting podcast. So in conversation with our friends over there, with some exciting stuff going on. Also having more universities are reaching out to us because that's one of those interesting things that I always find I'm always humbled by is when I get a message from, let's say a professor or someone in academics at a university, and they're like, hey, we've been following your content. We're actually using your content in our classroom. To where I'm just like, man, that's pretty awesome.
That is pretty awesome. And I'm all about the non-traditional way of learning because I think sometimes there's a focus on just the textbook approach of things, but practicality and just kind of diving into the real life examples definitely makes a difference. So I think our podcast is a great resource for that. And I think even the approach we're taking today is going to be a phenomenal opportunity for people to learn about how to read, how to take information that the balance sheet provides and apply it to what's going on with their businesses. So I'm excited about the podcast today.
Yeah, absolutely. I was working on something because every now and then I get asked to do share my perspective on different topics, and especially within the accounting industry. And I think one of the things that I've said consistently is that accounting, its original intent was to help bring, better clarity to what was going on financially with businesses so that people can make smarter money decisions.
Right.
And at some point, we kind of got away from that to where that stopped being the focus and it just became more focused on how to be technically right or how to focus on doing audits or how to focus on, doing taxation. And we got further and further away from the decision-making process to where I was like, you know what? Our show has to be designed around that of how do you take, this technical accounting topics and these things that we understand in accounting, how do you make it more practical? And so I agree with you. I'm excited about today's episode because, we talked about, we wanted to do an episode on the balance sheet. And of course, you can go that route of like, well, the balance sheet tells you what you owe versus who you, your assets, your liabilities. And we can go through all the technical stuff, but I'm like, what would be a better way for people to understand the balance sheet? And so I'm definitely game for the non-traditional, very practical approach. So today we're going to have fun of Lola has picked a couple companies that you're going to bring up the balance sheet for these companies
Yes.
and we are going to talk through it. Now,
Yes.
I will say, to give a little bit of context, can you give a little bit of context for those people who are new of what's your background so they kind of understand, what insight and knowledge perspective you're bringing into this? So what's
My
your professional background?
My background. Oh, that's official. Okay, so my background is I've worked for over 10 years, feels a little bit longer, but 10 plus years in Fortune 500 companies. So I'm a CPA. I went to school for accounting and economics, and I have pretty much worked in a combination of operational, finance, and accounting roles. And basically, what that means is I've worked closely with presidents and the general managers, like the people that are actually making decisions in the business. And my biggest role, and this is something that I've enjoyed thoroughly, is being a partner to a financial partner to the operational leaders. So the people that are actually making decisions, giving them the information that they need to be able to make those decisions. And I think it goes really in line, Terrell, with what you said, which is accounting has kind of gotten away from, or had gotten away at some point from, being that giving you the information that you need to make decisions, to just basically debits and credits, making sure the numbers tie, and the technical side of accounting. And so my accounting and finance background has really been making information practical. And I've worked with sales guys, I've worked with marketing teams. So my goal is always to break it down to make it make sense for you and for your business, so that you can then turn around and make those decisions that you need. So that's my background. Terrell, how about you, or anything else you want me to share about me before we move on?
No, that's good. I would say my background, for those that don't know, is, I'm a master's in accounting, so I'm deeply trained in the technical side of accounting. Went into public accounting and realized I really wanted to get more into the actual operations of things. And so I spent probably the next 12 years of my life working on the operations side, a little bit of being a ghostwriter for Fortune 500 executives, really working with Wall Street analysts and how they looked at our financial information. How do you break that down and explain it in layman's terms? And so today's episode, we're getting back to like some of the core of the stuff that I really do enjoy, reading the financial statement, because I think there's so much information there that you can gain. Like, I remember early in my career when I was reading financial statements, and even some of my coworkers at the time were asking, like, what are you doing? Like, that is so boring. And I'm like, well, if you know how to read it, you can find the money and find the opportunities. And so today we're going to do that. We're going to look at a balance sheet and we're going to help people find the money, find the opportunities, and make sense of these balance sheets. So, what is the first company you want to run with?
So the first company I want to run with is Starbucks. So I thought Starbucks would be a great one for a couple of reasons. One, it's a popular company. It's one that a lot of people are familiar with. A lot of people spend a lot of their money at Starbucks every day. So if you're spending a lot of your money on this, in some respects, you do maybe have a vested interest in making sure they don't close their business anytime soon. But I also thought that would be one that's, relevant. So I will say, I'm going to pull it up on the screen, but if you are if you're listening to this on the podcast and you actually want to look at what we're walking through, what we're going to include a link to the to the balance sheet, but you can also go to YouTube to actually follow along what we're talking about. I'll include that link in the show notes as well. But yeah, so let's go ahead and get started with Starbucks. And I know you haven't reviewed these, but I'm actually very excited because I think one thing that you're really good at, Terrell, and I remember when we started dating, you were reading financial statements in your leisure time. And I was just like, I don't know what the heck this is. Um, this guy is like, in some respects, I felt like you were, in some respects, the stereotype of the accountant in that regard, where it's like you're really spending your free time reviewing financial statements. But I will say I've learned a lot from you on being able to read the signs of what, the companies are doing. And I think it's also helped me be able to explain that to other people. So I'm excited to kind of get your perspective and for you to lead us on the conversation. So Let's do it.
Absolutely. All right. So give a little bit of context for those that aren't familiar with publicly traded companies. Every quarter, publicly traded companies have to release their financial statements. So it's pretty much they're giving you an inside look at what's happening financially with them. This is a highly, highly, highly recommended thing. And this is why I recommend, that business owners, and if you're an accounting firm, you should be looking at the publicly traded companies that are similar to your clients. Because I always tell people this is like having a one-on-one sit-down conversation with the CEO and the CFO of these companies. And a lot of
Mhm.
times they're writing about their strategies or what they're doing. And some of
Yeah.
those you can actually take and help your clients implement in their businesses. And I know this because I used to be the guy who would have to write this for publicly traded companies. And so I remember sitting in the room with some of the senior executives and listening to them talk about the strategy. And then we would, figure out how to phrase it, how to write it down. But it is the executive's way of being transparent with their shareholders. Now, because they're publicly traded, anybody can buy their shares. So they have to make this information available to everyone. The sad part is most people actually never look at these reports. And
Yeah.
so when you start looking at these reports, you can start learning so much. Like I gained multiple promotions just based off of reading the report. And then the next meetings that I went to, I would talk about what I read, and people would be like, that guy is really on top of it. Like I literally got 2 promotions because of that. And
That's
so
really good. Yeah. And
I
I think
highly
like
recommend it.
yeah, and I was gonna say, I think internally and externally, right? So like within the company, but then also like just the point that you made about the business owners, accounting firm owners should be reading and should be tuning into like earnings calls and reading the financial statements for their customers, the type of customers that they serve. I think the connection that I would say for the business owner, because I think sometimes people are like, all right, like, why is this relevant to me as a business owner or even as a small business owner? And I think the reason why it's relevant to you as a small business owner is because of what you just mentioned, Terrell, where a lot of times these decisions that big businesses are making, or when you have that sit down conversation with the CEO or CFO and they're saying, hey, this is how we're pivoting, this is how we're changing our strategy. A lot of times that big business shift really indicates the direction that the market is headed in or the industry is headed in. And what it helps you really be able to assess is okay, what do I need to be doing different in my business to basically make sure that I'm not getting left behind? And I think that's a very important thing that a lot of people don't think through because I mean, even if we think about inflation, right? Or we think about, the recession, big businesses have been talking about a recession coming from the beginning of last year. Right? And they've been making moves and making decisions in accordance with that because even though the news didn't really start talking about the recession until what summer or like fall of 2022, big businesses had already started adjusting their strategies and being a little bit more conservative with how they were spending money because they saw that this was coming. And so as a small business owner or even as a medium-sized business owner, like that's why you need to pay attention to what's happening in your industry because it is going to indicate the direction that you're headed in. So that was one thing I wanted to kind of expand on more that you mentioned that I think is a really good point to bring up.
Yeah. And I think I always say is that being able to get an inside look at how other competitors or how other similar companies in your industry are operating, it's almost like having a cheat sheet
Yeah.
because you get to cheat off of other people's, work that they're doing. And plus, most of the companies that are publicly traded, they're spending millions of dollars in their strategy, putting things together. I'm like, instead of trying to recreate it and figure it all out on your own, just like it's almost like if you were in school and there was some students who were known for being at the top of the class, and if your professor told you like, hey, it is perfectly okay for you to cheat off their paper, anyone who chooses not to like look at their paper, I would really question, like, they just told you it was okay to do it, so technically it's not cheating if they just told you it's okay for you to do it. But there are a lot of people I think that are trying to learn the hard way. So let's jump into Starbucks. All right. So
Perfect.
Starbucks balance sheet. Now, they haven't, at the time we're recording this, they haven't released their fourth quarter financial statements. So we're working off of the
No, so
Q3.
sorry, let me be clear. So Starbucks has released their financial statements. This is what
Okay.
we're looking at. The next company we're going to talk about has not yet, but Starbucks, this is their year end
Gotcha.
ends in October,
Okay.
of October 2nd. So that's what we're seeing here.
Got it. All right. So
Mhm.
the numbers here are in millions. All right. So the first thing that I'm noticing when I'm looking at Starbucks' balance sheet is I'm definitely zeroing in on cash because I
Yep,
think, you know, right off the top, as I continually say when I speak at different places on this show, is that cash is king. And similar to
facts.
chess, when the king is down, the game is over. So
Mhm.
one of the things that I'm looking at here is why did cash go from 6.4, I guess this would be $1 billion,
Yep.
down to $2.8 billion? Like, what did they spend all of that money on? And so that's my first thought. And then I'm seeing like, okay, all right, did they spend the money on inventory, which means is stuff that we still have that we can sell and get more cash in the future? Or did they end up spending their money on other stuff that's not really giving us a long-term benefit? So what's jumping out to you first?
I will say the cash definitely jumped out to me, and I had to make sure I didn't get too ahead of myself because I know we're going to talk about statement of cash flows, but I was like, what was going on here? And one of the things that went through my mind, well, two things that I thought through is in 2021, there was a lot of focus on being more cash conservative, right? People weren't spending a lot of money in 2021. COVID was just, we were kind of at the edge of coming out of COVID. So I can see why there's maybe a big decline in their cash reserve because probably spent more money investing more in 2022 with the return of, opening locations and things like that. Whereas probably during COVID, they were a little bit more reserved with that. So cash was definitely the first thing that jumped out to me. Any thoughts, any other things you think that maybe the money may have gone towards with such a huge decline on cash?
Yeah, so a couple of things that I'm looking at when I see a decline in cash like that. You go from 6.4 down to 2.8. I mean, that's what was that what 3
It's
point.
like a 3.2 million. No, am I doing my math right? $3.6 million decline.
Yeah, so you're looking at roughly, yeah, 3 point something $1 billion
Oh
decline
yeah,
in
sorry,
cash.
billion. This is billion
So
dollars.
I'm
Excuse
I'm I'm
me.
asking, the first question I'm asking myself is, what did you spend $3 billion on? Now, the first, I'm looking through the assets and seeing, were there any other asset categories that increase? I see
Mhm.
that the inventory went up some.
Yeah.
The inventory went up by, I guess that would be what, roughly what, 500 million. So
Yep.
I'm like, okay, all right, you spent 3.6 billion. 500 million of it went to your, buying more inventory that you can sell in the future. I'm like, okay,
Mhm.
that makes sense. You want to make sure that you have enough inventory to sell for future sales. Cool. That still leaves 3.1 billion. I need to figure out what the heck did you do with the other 3.1 billion?
Right.
And I'm looking, short-term assets went up just a little bit. So I'm like, it wasn't there. Then I start looking down, like, property, plant, and equipment. It doesn't look like you bought any new stores
Mhm.
or it doesn't look like you bought a lot more new stores and operations. You didn't buy a lot of equipment. And then I'm looking also at kind of like your, at any changes in other assets, and I'm just not seeing it. So the
Yeah.
question that it leaves me with here is, your total assets went from $31 billion down to 27.9 billion. I want to know, where did the rest of that money go? I mean, that's what, roughly that's still roughly $3
2.9.
billion,
Yeah.
give or take some or whatever, that we still don't have an answer for yet. Like, what did you do with the cash? Like, where did it go? So I would say that's the first thing that I'm seeing when I'm looking at the assets. Now, if we scroll down to the liability section,
1 second. Let
the
me.
next thing that I'm looking for is, did we happen to use that cash to pay off some of our debt? Or, and as I'm looking through that, I'm not really seeing the debt didn't really go down
If
that
anything, they
much.
borrowed more money, like short-term debt is up. They didn't have anything on short-term debt. They borrowed 175 million more versus last year.
Yeah.
Um,
So at this point, I'm really asking myself, like, your liabilities didn't go down. So you didn't use the money to buy, a bunch of assets. You didn't use the money to pay down your debt. My last kind of overall thought is, did you use the money to, let's say, maybe buy back some of your stock? Or did you use the money to give like special dividends to your investors? Because again, we're still looking for $3 billion of
yeah,
cash or $3 billion of value. That I'm like, where did it go? Now, of course, next, in our next episode, we're gonna talk about the cash flow statement. That's probably the easiest way to see it. But when you're looking at the balance sheet, I mean, I think that's the thing you're looking at, because even for smaller businesses, I mean, when you're going to try to get a loan, these are some of the things that the bank, if it's a serious loan, these are some of the things that the bank is looking at, is like,
right.
what happened on your balance sheet? Like, because the balance sheet can tell us a lot about, your behavior with cash and your behavior with debt and assets. And what I'm seeing, from what I am seeing from Starbucks, without saying anything else, I'm really asking myself, like, hey, why are you guys spending so much cash, and where is it going?
Agreed. Yeah, they spent a lot of money. I think that, and I'm actually, I think on the next episode it would be great to actually use Starbucks and go through their statement of cash flows, because I'm really interested to see where they spent their money, because you actually made a good point on the investments piece, right? Because I was thinking, well, maybe, off the bat, just seeing cash, I was like, well, maybe, they just spent more money investing and on, buying new locations or opening new locations or opening new stores. But then to your point, like PPE, the property, plant, and equipment didn't really go up by much, like 200 million. So still doesn't really answer the question. And one of the things that I actually found that was interesting, I don't know if this is going to maybe change your perspective. I didn't know this. About 50% of Starbucks stores are actually operated by the company, and then 50% are franchise owner or franchise owned. So could that be a reason, or could there be anything maybe that happened in there that we're not seeing in here that may have driven the explain maybe some of the gap?
Well, I would say, I mean, my first thought is, this really seems like, if you scroll down a little bit more,
Mhm.
down to the equity section. So let's see. Yeah, so really what this tends to look like to me is, if they didn't do any special dividends or whatever, what it kind of looks like is that they weren't as profitable.
Yeah.
That would be my first guess, is that they were either investing money in their operations, or maybe they had some big expenses and sales were just down that much that
Mhm.
they lost money. Which $3 billion is a lot to lose.
It is.
But yeah, it's not jumping out to me based on what we're seeing here
Yeah.
as to where that money went.
No, that's good. That's a good
Especially,
point.
I would say, especially when you consider the fact that, like I said, their debt didn't really change a ton. I mean, like, their total liabilities went down by $100 million. So
Yeah,
you
it's not a lot.
use, you use like what, half a billion to pay, to buy more inventory. Your liabilities went down by 100 million. So you paid down some of your debt. But then I'm still like, there's still roughly $3 billion. We need to figure out, like, where did it go? Like, where did that get used?
Yeah, no, that's good. And I think another thing also that I saw on the earnings release that they mentioned was, when you talk about like their sales being down, was that they were focused more on heavy focus on the Americas market, because they had been trying to expand outside the US and there was a lot of volatility there. So, maybe they spent a lot of money in that area and it just didn't really yield as much of sales as they thought it would. So just a thought. But yeah, do you want to go to our next company or any final thoughts on Starbucks before we move on?
Yeah, no, I'll be interested to hop in and break down the cash flow statement in the next week. So I am good on Starbucks for now.
All right. Well, the next company we're going to be talking
Well,
about.
I guess before we jump off Starbucks, I mean, I think to make it even more practical for, so if you're a business and you're running a coffee shop, or your business and you run like a tea shop, or you're selling products similar to Starbucks, like this is something to pay attention to. I mean, because one of the things that we may find out is the reason why why their value or their asset value went down so much is because they didn't make as much money. And the question you got to ask there is, hey, are the buying habits of the Starbucks customers changing some? You know, is it that it's probably that, hey, it got more expensive to operate a Starbucks store, whereas like food costs went up, you know, employee costs went up, like to running the Starbucks business got more expensive and they weren't able to increase the sales by the same amount. So I think there's a lot of very relevant things that every business owner can think about. So what do we have for the next one?
So the next one I'm actually pretty excited to talk about. We're talking about Adidas today.
The
Let me open this.
Adidas.
Adidas. So the reason I picked Adidas.
Can you
or
zoom
Adidas.
in just a little bit?
Yeah. Give me a second.
All
How's
right,
that?
great. That's perfect.
All right. The reason why I picked Adidas, I know. We'll get to it. I was shook. I was confused. But let me just make this a little smaller. And the audience will be able to tell relatively shortly what we're talking about and what warranted that response that Terrell just had. But the reason I picked Adidas is because they've been in the news a lot recently for a couple of reasons. Well, the main reason they've been in the news is because of they carry Kanye West's product, the Yeezys, I think is what they're called. I don't own any, so I'm not sure. I think that's what they're called. And this has been historically a very profitable partnership for them. So they have allegedly, I don't know how much, they didn't disclose it. It may have been 300 million plus. I don't remember the exact amount, but they have a lot of inventory left. As some of you, if you're not familiar with what's going on, there was some controversial stuff that Kanye West had mentioned on social media. And so Adidas discontinued their deal with him and basically cut ties. And so what's happening now, and this is why I love accounting, because you can always connect it to real life. But what's happening now is Adidas has been left with all of this inventory of Yeezys and all of these Kanye West products that they're now trying to figure out if they should dispose of, try to sell off, or I guess dispose of, write off. So that's why I wanted to talk about Adidas, because I thought it would be good to kind of see what's going on with their numbers.
Well, this one will be interesting. Okay, first thing that jumped out to me was this cash and cash equivalents. I mean,
yes,
and these numbers are in these are in what, million euros is what this is?
This is in, yes, €1 million. So it's actually 800. That's 806 million.
Yes.
Okay. Yeah. So they are in euros. They're in millions. And there was one more comment I was going to make. These are just third quarter results because they have not yet released their 2022 financials as of yet.
Okay. So, I mean, this is just telling us at the end of third quarter, here's what their position looked like. I mean, because that's an important thing to know about the balance sheet. The balance sheet is telling you what their financial position looked like at that point in time. So in this case, at the end of September of 2022, and you compare that to the same time the year before, Adidas had $3.6 billion in cash and cash equivalents. Fast forward a year later, September 30th, 2022, they had $806 million. So I'm like, that's what, 2.8? Is that 2.8. Roughly what, 2.8 billion? So immediately I'm asking myself, like, that's what is that? A 77% change?
Yep.
Yeah, a 70, like 77% of your money has gone out the door. I mean, because even if you think about it in smaller terms, is, let's say, if you had $1 today, and let's say, a year later, I took away 77 cents out of your dollar. Like, you were literally left with 33% of what you had before. So
Yeah.
the very first question that I am wondering is, what is going on? Like, what did you spend all that money on? Or like, where did
Right.
that money go?
Right.
Now, it's important what you just brought up about the inventory and, their dilemma that they're trying to think through, because a lot of that money, when it looks like inventory had the biggest jump, like the
Yep.
inventory went up by almost $3 billion.
Yep.
And so it's like their inventory went from 3.6 to 6.3. Now, the question I'm asking is, if they write off all of the Yeezys or Kanye West related inventory or whatever, like, how much money are they going to lose from that if they write that off? Because I mean, most of their money, like their biggest change, happened there. So that was why when you pulled it up, I was like, oh wow, okay, this is gonna be interesting.
And actually, I just looked it up real quick on the internet. So allegedly, according to this hyper beast, I don't even know if that's like a legitimate site, but they're saying that Yeezy inventory is valued at around 1.3 billion US dollars.
Oh wow, that's that's
So
that's tough.
as of euros, I think euros right now is about equivalent to dollars. I don't know what it was, what rate it was at as of Q3,
Mhm.
but I mean, that's like half of their increase, basically, right? So,
Yeah,
like, because they went up like 2.8 million, I'm sorry, 2.8 billion euros quarter over quarter, 2021 versus 2022. So yeah, that's 1.3 billion US dollars worth of inventory. They have to decide if they want to sell or write off. Who
yeah.
would want to be an investor and not having that conversation in that room?
I mean, I will say, from being in some of those rooms with, you know, some of the largest investment firms, and sitting down with CFOs, having to prepare CFOs for those meetings, like those
Mhm.
conversations can get very, very tense.
Yeah.
And I think that's where, like I said, if you're looking at the numbers, you can start to see the signs of things changing. You can kind of get a feel for what's going on. And I always tell people, is before you invest in a company, or before you even go all in on an industry, look at how some of the major players in that industry are navigating it. Now, I will say something else that jumps out to me is the accounts receivable. Now, because when most people think about Adidas, they think like, hey, if you go to, let's say, Foot Locker or Dick's Sporting Goods and you buy a pair of Adidas, that Adidas corporate makes money. And I'm not necessarily sure how their contracts are set up with these stores, whether they just sell product to Dick's Sporting Goods and then that's their, and then anything that happens after that all belongs to Dick's Sporting Goods. Like, I'm not sure how their sales arrangements work, but the fact that their accounts receivable went up, what that means to me is it looks like either they sold a lot more shoes,
Mhm.
or people are taking longer to pay them. And,
Yeah.
and I think for any business that becomes important, is like, if your accounts receivable balance is going up, but your sales are pretty flat, what that means is your customers are struggling to pay you, which means you're probably going to feel the pinch when it's time for you to pay your vendors, or for you to make payroll, or even for you to pay yourself as the owner.
Yeah, and I'm looking at the numbers. Adidas only grew 11% on their revenue. So it's definitely a delay. So they only grew 11% Q3 2022 versus Q3 2021.
So yeah, and I will say as well, their AR only went up by 11%.
Yeah, you're right. I'm looking at that
So
now. So it makes sense.
but one of the things that I would say is, like, if I was Adidas and I was in that situation and I see that my cash went down from 3.6 billion to 800 million euros, I'm like, okay, all right, what kind of changes can we make on our accounts receivable terms?
Right.
Because we need to get more cash in the door. Like, hey, can we can we do something to make sure that we have enough cash to run the business? Because if we run out of cash, especially if they're debating about whether they're going to write off the the entire Yeezy inventory line, like that could be pretty interesting for them.
Yep.
So the other areas, I mean, if you can keep scrolling down,
All right.
it doesn't look like much really jumps out to me on the other categories.
What would
There
other
was
intangible assets be? I guess like the branding or the would it be like the well no trademarks would be like the branding like the Yeezy brand and stuff like that, right?
well, I guess this is like kind of like a technical accounting. Like, so whenever I see goodwill, trademarks, other intangibles, to be
Mhm.
honest with you, you really got to look at their 10K, and in the 10K they explain like what falls into those categories,
Got
because
it.
it isn't like there's a set rule of only this can go in other intangibles. So you would have to look at their actual 10K or 10Q, because in that they're gonna, like, every company that produces one of these financial statements have to put notes explaining like, hey, what goes into this category versus that category.
Yeah. So that looks I mean, I think all in all just based on what we're seeing with Adidas numbers, I feel bad for them. I mean, it is a company after all, but I think for me this is one of those situations where I think they really betted heavily on the Yeezy products and they were doing really well and it was working really well for them. And I think if I think about a company that sells shoes or apparel, it's fast turning inventory. And so it makes sense to me that they have a larger inventory balance. But I think one of the things that you have to work through, especially as a small business, is how much inventory is enough. Because when situations happen where you're not expecting it or you didn't plan for it, can you still move that inventory relatively quickly? And so that for me is like one of the takeaways as I'm reading this is like, I get that their inventory balance is as large as it is. I think for a company that turns over relatively quickly on the products that they sell, it makes sense. But now, really, half of that increase I wouldn't say necessarily tied to the Yeezy products, but it's like, hey, half of that, because what was their number again? The inventory number is 6.3. So of the
Mhm.
6.3, they had, and I don't know what the updated numbers are, but they had about 1.2 billion of inventory tied to Yeezy. So, I mean, that's a loss. If they decide not to sell any more of those products, that is now a loss that they're going to have to take. All
Yeah,
right.
I mean, it is very interesting. I mean, because I think when you start to look at it in this way, you start to really get back to what are some of those strategic business decisions that you have to make.
Hmm.
Like I said, when we started off looking at the cash, like, you have to make sure you have enough cash coming in your business to continue operating and doing, the different things that you're doing. Because you can look at this and say, well, we have 6.3 billion in, in inventory, we got 3.2 billion in AR. When you look at property, plant and equipment, we got 2.3 billion there. Like, yes, those things may have value attached to them, but if you can have all of that, but if you run out of cash, you're still going to be hurting. So
Right.
I do think that part of running a successful business is making sure you have enough cash to fund what you're doing. Now, I'm curious to look at their liabilities. So can you scroll down a little bit more? All right. And
Absolutely.
let's see what's going on in the liability section. All right. So
Is that
first thing
good?
that jump,
Can you read that okay?
can you zoom in a little bit more?
Yep.
Right there's fine. All right. So first thing I'm seeing is their total current liabilities went up by almost 2 billion euro. And most of that is in accounts payable. So what that means is they're taking a little longer to pay other people. Now, I don't know if that is because, like, hey, they're buying more, and it's probably because they bought more stuff. Because if their inventory went up, they probably bought more materials from their vendors, and they're kind of trying to match the timing. Like, we don't want to pay our vendors before we get paid from our customers.
Yeah, that
So
explains the increase in accounts payable. What about the short-term borrowings? That's a pretty
So
big
the
increase.
short-term borrowing. So some of that with short-term borrowings is some of that short-term borrowings could have been stuff that was long-term in the prior year. It's just now that stuff is becoming due within the next 12 months. So it just moves from long-term into short-term because what we're seeing is the short-term numbers went down some, and I mean, the long term borrowings went down, the short term borrowings went up. So it may just be that, hey, some of that was a shift. Like some of that growth is just related to, you know, long term that now became short term, but they did borrow some extra money. So part of the question I think you got to ask yourself is if you are borrowing money to run your, to fund your business, like, are you putting that money in a place that is going to be profitable?
Yeah,
And it
I
looks like they invested heavily in inventory. And the question is that going to pan out?
Yeah, that's a good question. I think one thing I will applaud them for here is the increase in accounts payable. Because what this number tells me is that they are doing a good job of managing their cash or trying to manage their cash more so because it's like I guess you already have your cash burn relatively quickly. Like your money is you're losing a lot of money based on what we saw. There's a pretty big gap versus where they were last year. But this at least gives me a signal that you know what they are controlling how quickly they're paying back the money that they owe. And I think as a business owner is as you're taking more funding or I guess loans or maybe capital into your business, you need to be mindful of how quickly that money is going outside the door or out the door, or as you're investing, you know. So I think there's really that balance between your accounts payable and accounts receivables. And large companies have entire departments that are dedicated to collecting on money that's owed. And so I would have just liked to see them kind of be a little bit more aggressive on the accounts receivable side because that number going up didn't really help their cash position. But I think the AP, at least accounts payable here, from what I can see, it looks like they're doing a good job of at least trying to manage how quickly the cash comes out the door.
Absolutely. So if you scroll down a little bit more and see if
Yep.
there's anything else in like the equity section.
So
Um,
if I look here,
okay, so nothing here really jumps out in a major way to me, kind of in the equity section, except for like I said, retained earnings went down, which is likely a factor. My guess is that they probably lost money in 2022. Um, Yeah, that would be my guess. Now, this is something that you don't see this in every set of financial statements, but sometimes you see it. Like what they have is their additional balance sheet information. So when they're looking at like operating working capital, like the big one is the finance leverage. Um, if you look at the finance leverage, there, last year they were like 42.3%. This year they're up to like 104%, which to me tells me like that is pretty leveraged, meaning like they are relying on debt a lot more this year than they were in the past. Like
and
in
this
the
is before the
past,
Yeezy scandal, so I don't know. I'm concerned.
yeah. So I think this one is, and again, if you're a business and you're trying to go get a loan, like if you're trying to get a substantial loan, they're looking at stuff like this, like how leveraged are you? Like how dependent are you on the debt to run your business versus you being able to generate enough cash flow from your operations to run your business? And for if you're a small business, that's looking at things like, your credit card debt, your line of credit, your business debt, and they're looking at that saying like, if you were not able to get any more debt,
Mhm.
could you still finance your business? And for a lot of businesses that, like, say, if you're over 100%, what that tells me is if you lost the ability to take out new debt, you might really struggle. And that's
Mm,
not to say that, hey, your business is dead. That just means, like, hey, you probably got to tighten up some things around cash, and you're gonna have to make some smart decisions about how do we either reduce our expenses, how do we reduce some of the risk to
yeah.
get more cash flowing or positive cash flow flowing in the business.
Yeah, and it tells me that you're very dependent on other people to help fund your business, which can be dangerous as a small to medium business because if something happens today, you're not in a position where you can bounce back quickly. So, something to be
Absolutely.
mindful of.
Absolutely. So that is, I mean, and I think that for a lot of small business owners, like they may be thinking to themselves, like, when you're looking at a major business like this, like I'll be honest, there's an entire department that is there putting these numbers together. There's an entire department that's analyzing these numbers. And, for a lot of small business owners, they don't have the time to like constantly pull these reports to analyze these numbers, even for accounting firms. Like, a lot of times bookkeeping firms and accounting firms, they don't have all the time to dig into these numbers. And so something that I've recommended to a lot of people is, using a simple tool like LiveFlow. And one of the ways that we were able to do that is we set up templates for every
Mhm.
single client to pull their balance sheet. And we already have like the formulas built in to analyze the key factors of seeing how leveraged are they. Let's see the change in their assets versus the change in their liabilities. And I think if you can figure out a way to automate that, I mean, I think it gives you a better chance to keep an eye on the things that could be leading your business down the wrong path. But I think if
Yeah.
you're watching that on a regular basis, it's going to put you in a much better situation. And your business won't be one of the ones that we're talking about on the show, like with Adidas. Like what we saw with Adidas is that there
That's a
is
little
some
bit
serious
scary.
concern there.
Yeah, that's a little bit scary. And I think one of the last pieces of advice I was going to issue is if you're a business owner and you have an accountant, and I would recommend having a conversation with them about doing a regular review on the balance sheet, because I know there's a lot of times that where there's a lot of focus on the P&L, but like the LiveFlow tool is a really good way to get that data real time, even if they're using, recommending the LiveFlow tool to them to be able to do that and be able to get for you to be able to see that as transactions are being made every month. Okay, based on my expenses in the business, what do my numbers look like? And that data gets refreshed automatically. So I think at the end of the day, as a business owner, you need someone to help you make simpler, quicker decisions, data-driven decisions. And I think just simplifying it with some of the tools that we use for our clients definitely makes a very big difference. So I enjoyed this
Before we,
conversation. What
I
were you
would
gonna
say
say?
before we wrap up, do we have a tax tea that you wanted to share this week, or do we want to put that off to the next fun episode?
You know what? I would say we put it off. I know people are gonna be disappointed, because, it's a pretty big deal, but I would say maybe let's put that off and we can come back to it on our next episode.
All right. So we will come back to it on the next episode. Now, one of the things that I would do want to remind accountants, if you want to get CPE for listening to this episode, definitely check us out on the Earmark app, because you can listen to the episodes and you can answer a couple of questions and you can get CPE credit for listening to the stuff your accountant isn't telling you when you listen on the Earmark app. So thanks for tuning in, and until next time.